As we mentioned earlier, Fed Chairman Ben Bernanke hinted at more easing if the global economy or the U.S. economy doesn't pick up. For more on this, Peter Morici, Professor of International Business at the University of Maryland, thank you very much for joining us here on this very unique topic. For a lot of folks, they don't realize how big Jackson Hole is. But today's comments from Federal Chairman Ben Bernanke, how do you read his comments in terms of he'll do more if things get worse?
Well, the Federal Reserve can simply go out and print money. It can print money and it gets it in circulation by buying bonds in the bond market or buying loans on the books of banks. That gives them more liquidity, which they can lend to businesses and lend to people who want to buy homes.
We throw out a lot of terms on this show, QE1, 2, and of course we're talking about really QE3. And what you're describing is partly about QE3. Maybe you can help some of our viewers better understand this, and we talked about this earlier, is what exactly is QE3 and how is that different than all the other QEs?
It's not really different. Quantitative easing is buying long bonds, 10, 20, 30-year maturities, by printing money, buying those bonds and directly lowering mortgage rates. And that's essentially what QE.
Long-term rates lower in the hopes that banks and consumers and businesses will borrow money to spend money. Is that the idea?
Exactly. That folks will buy homes, for example, which would push up housing prices and give people better balance sheets and incline them to spend more.
Now, I'm going to say something really silly here because long-term rates in the United States are near historical lows, as is mortgage rates. So if that was the goal of QE1 and 2, that for the most part has been what appears to be achieved, what can be achieved, or what would the goal of QE3 be then?
That is very unclear to me. I believe that another round of quantitative easing will not do much good. We've had a large inflow of European money into the long bond market in recent months because of conditions there, and that has had the same effect. It's hard to imagine that lowering mortgage rates any further would do much good.
I don't want to get into politics here, but there is a little bit of political pressure on the Fed chairman here because everyone's critical of what the Fed is doing. But in terms of the overall economy here, as we look towards the future and you see the possibility of potential quantitative easing, what is the risk to the U.S. economy and what might be the risk to the global economy?
Well, there are certain economic risks. If we push interest rates too low on mortgages, then when the economy someday recovers, folks will find that they bought houses for prices that are unsustainable. Mortgage rates go up and they can't sell the houses for those values. There's also the issue of the credibility of the Federal Reserve. If it goes through a large exercise of quantitative easing, yet again, QE3, and there are no appreciable consequences, then the Fed loses a lot of credibility going forward.
You know, a lot of people talk about the money printing. I mean, they make a joke out about it, basically. And what's wrong with printing more money?
Well, if you have too much money around, you get inflation. That's part of the problem that we had in China until recently, because in an effort to keep their currency at a stable level, which they considered appropriate, they would print a lot of yuan to buy dollars, and in turn those returned to the Chinese economy and caused inflation.
Do you believe that the Fed will take action in the months to come prior to the election?
I do, simply because there's so much pressure. It's unfortunate, but political pressure has come to bear on the Supreme Court, on the Federal Reserve, on all kinds of institutions that heretofore were considered to be sacrosanct or above politics. It's a very unfortunate condition in Washington these days.
Peter, I want to thank you for your analysis. Wonderful having you on, and we'll certainly have you back again.